There is a powerful and deceptive myth at the heart of the financial world. A myth so pervasive that it paralyzes millions of aspiring investors and entrepreneurs before they even begin. It's the myth of complexity. It whispers that to succeed, to truly build wealth, you must be a master of all domains. You need to understand macroeconomic trends, geopolitical shifts, currency fluctuations, the intricacies of dozens of industries, and the technical charts of thousands of companies. It presents the market as an unconquerable labyrinth, and to navigate it, you must be a genius, a polymath with superhuman processing power. This belief is not just wrong, it is the single greatest obstacle to achieving financial freedom. It creates a state of perpetual overwhelm, leading to shallow, panicked decisions spread thinly across a vast and unknowable landscape. But what if the entire premise is a lie? What if the path to extraordinary wealth isn't about knowing everything, but about knowing a few things exceptionally well? What if the secret to beating the market wasn't frantic activity, but profound, disciplined patience? This is not a hopeful theory. It is the demonstrated reality of the most successful investment career in human history. Warren Buffett's entire multi-billion-dollar empire, the sprawling conglomerate of Berkshire Hathaway, is built not on hundreds of brilliant insights, but on a mere handful of great decisions. The core principle is deceptively simple. A successful investment career only requires you to be right about a few big, important things, while systematically avoiding major, catastrophic errors. This is the philosophy that transforms the frantic, overwhelmed amateur into a focused, confident master. It's a shift from being a jack of all trades to a specialist, a master of a tiny, self-defined domain. By focusing all your energy, all your intellectual curiosity, on developing deep, almost unassailable expertise in a few select areas, you gain a real, sustainable edge. You stop playing everyone else's game and force the market to play yours. This is the journey we are about to embark on. We will deconstruct this powerful investment strategy into its fundamental pillars, translating Buffett's folksy wisdom into a concrete, actionable blueprint for wealth building. We will dismantle the myth of complexity and replace it with the power of focus, proving that you don't need to be an expert on the world. You just need to be an expert on your world. This is the path to simplifying investing, to reclaiming your mental energy, and to making the handful of high-quality decisions that can and will build a fortune. The foundational concept, the very bedrock upon which this entire philosophy is built, is an idea Buffett calls the circle of competence. It is the most important mental model for any retail investor, entrepreneur, or CEO to internalize before making a single decision with their capital. It is not about limiting your ambition, but about aiming it with lethal precision. It is the art of defining your own battlefield, a territory where you possess a genuine, analytical edge over the vast majority of other market participants. To truly understand its power, we must travel back to a time of irrational exuberance, a period when Warren Buffett looked like a relic, a man left behind by a new, digital economy he refused to embrace. The late 1990s, the dot-com bubble was in full swing. The world was electric with the promise of the internet. Companies with no profits, no tangible assets, and often no coherent business plan were seeing their stock prices multiply overnight. Names like Pets.com, Webvan, and TheGlobe.com were the darlings of Wall Street. Analysts who had spent their careers valuing businesses based on earnings and cash flow were now inventing new metrics like eyeballs and network effects to justify valuations that seemed to defy gravity. In this euphoric environment, Warren Buffett and Berkshire Hathaway were objects of scorn. Barron's, a leading financial publication, ran a now infamous cover story in late 1999 titled, "What's Wrong, Warren?" The article painted him as a stubborn old man, a titan of a bygone era whose value investing principles were hopelessly outdated. Berkshire's stock was lagging the market badly. While the Nasdaq was rocketing up by 85% in 1999, Berkshire's Class A shares actually fell by nearly 20%. The pressure was immense. Shareholders were grumbling, pundits were mocking. Everyone, it seemed, was getting rich on technology stocks like Microsoft, Intel, and a new wave of internet startups, and Buffett was sitting on the sidelines, holding on to his boring insurance companies, his shares in Coca-Cola, Gillette, and the Washington Post. He was asked repeatedly, at shareholder meetings and in interviews, why he wasn't participating in this historic wealth creation event. His answer was always the same, delivered with unnerving calm and consistency. He would say, "I don't know how to value them." He explained that he had no idea what a company like Microsoft would look like in 10 years. He couldn't confidently project its earnings or its competitive position. He would say, "It's not that I have an opinion that they're overpriced, I just don't have an opinion. And I don't get an opinion. We've seen all kinds of companies. We were in the airplane business, the department store business. I've been in all kinds of businesses that are very tough, and I don't have to play in every game." This was the circle of competence in action. For Buffett, his circle included businesses he could understand with near-perfect clarity. He understood the brand power of Coca-Cola, the simple, repeatable economics of a Gillette razor blade, the competitive moat of a dominant local newspaper. He could visualize their financial performance a decade into the future with a high degree of confidence. Technology, for all its world-changing potential, was outside that circle. It was a black box. He didn't know which search engine would win, which software would become the standard, or which e-commerce company would survive the inevitable shakeout. And so, he did nothing. He was willing to endure the ridicule, the underperformance, and the immense psychological pressure of watching others get rich, because the one thing he feared more than missing out on gains was taking a permanent loss of capital on something he didn't fundamentally understand. Of course, we all know how the story ended. In March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, collapsed. Over the next 2 years, it would lose nearly 80% of its value. Those high-flying dot-com darlings vanished, wiping out trillions of dollars in shareholder wealth. And as the wreckage burned, Berkshire Hathaway, with its portfolio of boring old economy businesses, began its steady, relentless climb. Buffett hadn't predicted the crash. He never claimed to. He simply refused to play a game where he didn't know the rules. He stayed firmly within his circle of competence. And that discipline, that intellectual honesty, not only protected him from the carnage, but allowed him to emerge stronger than ever, with his capital intact, ready to deploy into the bargains that the panic had created. This anecdote is not just a story about market timing, it is the ultimate lesson in intellectual humility and the foundational principle of a sound investment strategy. The psychological principle underpinning the circle of competence is a direct antidote to one of the most dangerous and pervasive cognitive biases, the Dunning-Kruger effect. This is the well-documented phenomenon where individuals with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. In the world of investing, this bias is rampant and ruinous. A novice investor reads a few articles, watches a few news segments, and suddenly believes they have a sophisticated understanding of a complex industry like biotechnology or semiconductor manufacturing. They mistake a surface-level familiarity with genuine expertise. This is compounded by another powerful bias, overconfidence. Success in one domain, say, being a successful dentist or lawyer, often breeds a dangerous overconfidence that this intelligence is transferable to the vastly different and more complex domain of financial markets. The dentist who successfully runs their own practice starts to believe they can easily pick the next winning tech stock, ignoring the fact that the skill sets are entirely unrelated. The circle of competence is a mental framework designed to systematically dismantle these biases through a rigorous application of intellectual honesty. It forces you to ask the most difficult question. What do I really know? Not what you think you know or what you've heard about, but what you understand at a fundamental, granular level. It demands a clear-eyed assessment of your own knowledge and, more importantly, a clear delineation of its boundaries. Buffett's refusal to invest in tech stocks during the bubble wasn't a statement about the future of technology, it was a personal admission of his own limitations. This act of self-awareness is profoundly difficult because our egos are wired to project competence. Admitting "I don't know" feels like a sign of weakness, especially in a culture that rewards confident-sounding predictions. Yet, in investing, "I don't know" is one of the most powerful and profitable phrases you can ever utter. It's the circuit breaker that stops the Dunning-Kruger effect in its tracks. It prevents you from confusing the easy act of buying a stock with the difficult work of understanding a business. By consciously drawing a line in the sand between what you know and what you don't, you create a psychological fortress. Inside the fortress, you operate with data, with deep knowledge, and with a justifiable confidence. Outside the fortress, you acknowledge there be dragons, and you tread with extreme caution, or more likely, not at all. This framework shifts the entire investment mindset from one of speculation to one of professional analysis. It's no longer about chasing hot tips or trying to outsmart the market on every front. It's about patiently waiting for opportunities to arise in the small patch of ground you know better than almost anyone else. This is a profound cerebral shift. It reduces the immense cognitive load of trying to follow everything and channels your mental energy where it can have the highest possible return. So how does one translate this powerful psychological principle into a practical, applied mental model? How do you, as a retail investor or an entrepreneur, build your own circle of competence? This is not an abstract exercise. It is a concrete blueprint for focusing your financial decision-making. The first step is to conduct a thorough and brutally honest inventory of your own knowledge. Take out a piece of paper or open a document and create 3 columns: professional expertise, hobbies and deep interests, and local knowledge. In the first column, list the industry you work in. If you're a software engineer, you have a deep, intuitive understanding of software development cycles, competitive dynamics between tech firms, and the difference between genuine innovation and marketing hype. If you're a doctor, you understand the healthcare system, the drug approval process, and the business models of hospitals and pharmaceutical companies in a way that a Wall Street analyst never could. This is your most powerful, pre-existing edge. In the second column, list the things you are passionate about, the subjects you study for fun. Are you a passionate gamer who understands the video game industry inside and out? Do you spend your weekends working on classic cars and understand the auto parts supply chain? Are you a foodie who can instantly tell which new restaurant concepts have a real, scalable business model? These passions are not trivial. They represent hundreds or thousands of hours of accumulated, specialized knowledge. In the third column, consider your local knowledge. You understand the real estate market in your own town better than a national analyst. You know which local banks provide the best service, which construction companies do the best work, and which retail centers are thriving versus dying. This is a geographical circle of competence. Once you have this inventory, the second step is to test its boundaries with a simple rule. Could you explain the business model of a company in this area to an intelligent 10-year-old in 5 minutes? And, more importantly, could you confidently describe what the key drivers of that business's success will be over the next 10 years? If the explanation involves complex jargon or relies on factors you can't control or predict, it's probably outside your circle. You should be able to say, this company makes money because people will always need to buy X, and this company has a massive advantage in selling X because of Y and Z. If you can't articulate it that simply, you don't understand it well enough. The third step is to explicitly define what is outside your circle. This is just as important as defining what is inside. Write it down. I do not understand biotechnology. I do not understand emerging market currencies. I have no edge in predicting the price of oil. This act of negative definition prevents competence creep, where you start to stray into areas you find alluring but don't truly understand. This too-hard pile, as Charlie Munger calls it, is your greatest protection against costly mistakes. Finally, the fourth step is to understand that your circle is not static. You can and should work to expand it over time. But this expansion must be deliberate and deep. Choose one adjacent area you want to learn about and commit to studying it for at least a year before you even consider investing a single dollar. Read industry trade journals, study the annual reports of the top 5 companies in the sector, listen to their conference calls. Go deep, not wide. This blueprint transforms your approach from a scattered, reactive mess into a focused, proactive strategy for long-term investing. You stop being a passive consumer of financial news and become an active, focused researcher in your chosen domain. This is the true path to developing an investment mindset that can consistently beat the market. To fully appreciate the wisdom of staying within a circle of competence, we must dedicate time to exploring the opposite approach, the path that 99% of market participants follow, often to their own financial ruin. This is the path of the know-it-all, the jack of all trades and master of none. This investor treats the stock market like a casino, a place of constant action and thrilling bets. Their process is driven not by deep analysis, but by headlines, hot tips, and the ever-present fear of missing out. Let's paint a picture of this individual. We'll call him Bob. Bob is intelligent, successful in his professional life, and reads the financial news daily. He feels he has a good grasp of what's going on in the world. On Monday, he hears a news report about the future of electric vehicles. Convinced this is the next big thing, he buys shares in 3 different EV startups he's barely researched, spreading his bets in the hope that one will be the next Tesla. On Tuesday, a friend at the gym tells him about a new cryptocurrency that's, quote, guaranteed to go to the moon. Bob, not wanting to miss out, diverts some capital into this highly speculative and unregulated asset, which he understands even less than the EV companies. By Thursday, the market is down, and a respected analyst on television is talking about the safety of dividend-paying utility stocks. Panicked, Bob sells one of his EV positions at a loss and buys shares in a utility company whose annual report he has never read. His portfolio is a chaotic, incoherent collection of impulsive decisions. It has no central theme, no underlying thesis. It is merely a reflection of the last 3 interesting stories he has heard. He is constantly busy, checking his brokerage account dozens of times a day, feeling the emotional highs of small wins and the gut-wrenching lows of small losses. He is mistaking activity for progress. The consequences of this approach are devastating and threefold. First, he guarantees he will have no informational edge. By spreading his attention across dozens of industries and hundreds of companies, he ensures that in any given transaction, the person on the other side of the trade, be it a hedge fund analyst who has spent 6 months modeling the company or a corporate insider, knows vastly more than he does. He is consistently playing on their turf, by their rules. Second, he incurs enormous costs. Every trade generates commissions and fees. Every quick sale of a winning position triggers short-term capital gains taxes, which are far higher than the long-term rates. These frictional costs act as a constant drag on his returns, a headwind that makes outperformance nearly impossible. Third, and most importantly, he is setting himself up for a catastrophic error. Because he doesn't deeply understand the businesses he owns, he is incapable of acting rationally during a market panic. When the price of one of his stocks drops 30%, he has no analytical anchor. He doesn't know if this is a temporary market overreaction creating a fantastic buying opportunity or the beginning of a slide to zero because the company's fundamentals are collapsing. Lacking true conviction, he will almost always succumb to fear and sell at the bottom, locking in a permanent loss of capital. This is the path of the 99%. It is a recipe for anxiety, high costs, and mediocre to poor results. It is the direct consequence of ignoring the circle of competence and believing that you can and should have an opinion on everything. The financial connection between adhering to a circle of competence and superior investment returns is not theoretical. It is direct, tangible, and can be seen clearly on a balance sheet and in a portfolio's performance over time. The primary advantage is a dramatic reduction in what we can call the, quote, unforced error rate. In tennis, a player who simply gets the ball back over the net consistently, avoiding wild shots out of bounds, will beat a more powerful but erratic opponent most of the time. Investing is no different. The majority of wealth destruction doesn't come from missing out on a high flyer. It comes from making a few disastrously bad decisions. investing in a fraudulent company, buying into a dying industry, or overpaying for a cyclical business at its peak. When you operate strictly within your circle of competence, your ability to spot these potential disasters increases exponentially. You understand the industry's failure modes. You can identify a weak competitive position or a management team making poor capital allocation decisions. As a result, your portfolio will contain far fewer zeros, companies that go bankrupt or suffer a permanent impairment of their business value. This preservation of capital is the quiet, unglamorous engine of long-term wealth building. Furthermore, the businesses you do choose to own will have far more predictable financial characteristics. Because you understand them deeply, you are selecting for stability and durability. This translates directly into the financial statements. The companies you own are more likely to exhibit consistent revenue growth, stable and high profit margins, and a strong return on invested capital. Their balance sheets will be less leveraged and more resilient. This financial stability creates a smoother, more predictable compounding of your wealth. While others are on a volatile roller coaster of speculative bets, your portfolio is on a steady upward climb, powered by the real, underlying earnings of the great businesses you own. This approach also has a direct impact on your portfolio management strategy. Instead of a widely scattered collection of 50 or 100 stocks you barely know, you end up with a more focused portfolio of 10 to 15 businesses you know inside and out. This concentration, which we will explore later, is the key to translating deep knowledge into extraordinary returns. When you find a truly great idea within your circle, you have the confidence to make a significant investment, allowing its success to have a meaningful impact on your net worth. This combination of avoiding catastrophic losses and concentrating capital in high-conviction ideas is the one-two punch that allows a disciplined retail investor to achieve results that are far superior to the market indices over the long term. It is the tangible financial manifestation of choosing depth over breadth, focus over frantic activity. It is the real-world outcome of defining your battlefield and only fighting the battles you are overwhelmingly likely to win. This is the first and most critical step in building a framework for a successful investment mindset that leads to genuine, lasting financial freedom. Once you have defined your battlefield by establishing your circle of competence, the next great challenge arises. Within that circle, countless opportunities will appear over the years. The temptation is to act on many of them, to constantly be, quote, in the game. This is where the second pillar of Buffett's philosophy comes into play. A powerful mental model that enforces extreme discipline and selectivity, the 20-slot punch card. It's an idea that directly combats our innate bias for action and forces a profound shift from a mindset of activity to a mindset of profound patience. To fully grasp this concept, imagine yourself back in business school. Warren Buffett is a guest lecturer, and he makes you a unique proposition. He says, I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it. With this ticket, you get to make 20 investments in your entire lifetime, and that's it. Every time you make an investment, you punch one of those 20 slots. Once you've punched all 20, you can't make another investment for the rest of your life. He lets that sink in. The room is quiet. Then he continues, under those rules, you would really think carefully about what you did. You would be forced to wait for an investment that you were absolutely certain was a winner before you punched one of those precious slots. You'd make damn sure you knew what you were doing, and you'd reject everything that wasn't a truly outstanding opportunity. This is not just a clever thought experiment. It is the operating principle behind Berkshire Hathaway's greatest successes. Buffett's career is not a story of hundreds of good investments. It's a story of a few dozen truly exceptional ones, into which he concentrated enormous amounts of capital and held for very long periods. He bought American Express during the salad oil scandal in the 1960s, the Washington Post Company during the market pessimism of the 1970s, Coca-Cola after the market crash of 1987. Each of these was a high-conviction bet, a decision so well-researched and so compelling that it was worthy of, quote, punching the card. Consider the anecdote of his investment in See's Candies in 1972. Buffett and his partner Charlie Munger were offered the chance to buy the California-based candy company for $25 million. At the time, See's was earning about $2 million after tax, so the purchase price was 12.5 times earnings. This was significantly more expensive than the deeply undervalued cigar butt companies Buffett had built his early career on buying. Many value investors at the time would have walked away, deeming it too expensive. But Buffett and Munger did the deep work. They recognized that See's had something invaluable that didn't fully appear on the balance sheet. A powerful, durable brand that commanded tremendous customer loyalty and pricing power. People in California had an emotional connection to the brand, associated with holidays and celebrations. This gave See's the ability to raise its prices year after year without losing customers, a truly phenomenal economic characteristic. They saw that this wasn't just a statistical bargain, it was a wonderful business. They made the decision, effectively punching one of their metaphorical slots. That $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, earnings that required almost no additional capital investment. It was a single decision, one punch on the card, that has delivered returns for 5 decades. This is the power of the 20-slot mindset. It forces you to screen out the merely good ideas and wait patiently for the truly great ones. It shifts your perspective from, "What should I buy today?" to, "Is this one of the 20 best opportunities I will see in my entire life?" This is a radically different and vastly more powerful question. It acknowledges that in a lifetime of investing, true, no-brainer opportunities are exceedingly rare. Your job is not to be constantly active, but to be prepared, with deep knowledge and available capital, for when one of those rare opportunities presents itself. It turns investing from a frantic daily activity into a long-term, patient hunt for the exceptional. This mental model is the ultimate tool for simplifying investing and instilling the discipline required for extraordinary wealth building. The underlying psychological principle that the 20-slot punch card so brilliantly neutralizes is the action bias. This is our ingrained human tendency to favor action over inaction, even when inaction is the more logical and profitable course. We feel that if we are not doing something, we are not being productive. In the context of portfolio management, this bias is a portfolio killer. The constant stream of financial news, the flickering stock quotes, the chatter about the market's daily moves, it all screams at us to act. Buy this, sell that, rebalance, trim, add. The brokerage industry is built on encouraging this bias, as every action generates a commission. The 20-slot punch card is a powerful psychological circuit breaker against this impulse. By artificially creating a sense of extreme scarcity, it reframes every decision not as a trivial click of a mouse, but as a monumental, almost sacred act. It forces you to engage the slower, more deliberate, and more rational part of your brain, System 2 thinking, as described by psychologist Daniel Kahneman. Instead of a quick, intuitive, "this looks good" reaction, you are compelled to engage in a deep, analytical process. The scarcity of the slots also powerfully engages the principle of loss aversion. We feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. When you view each investment slot as a precious, irreplaceable asset, the fear of losing a slot on a mediocre idea becomes incredibly powerful. This fear of wasting a punch is a far stronger motivator for discipline than the abstract goal of achieving high returns. It forces you to raise your standards to an exceptionally high level. You start to think not just about the potential upside of an investment, but about the opportunity cost. Is this investment so good that it's worth forsaking all the other potential investments I might see for the next several years? This question dramatically reduces the number of ideas that will pass your filter. The punch card model also helps to combat the paradox of choice. The idea that while we think we want more options, having too many choices often leads to anxiety and poorer decisions. The financial markets offer a virtually infinite menu of choices. The punch card simplifies this radically. You are no longer looking for something to buy from an endless list. You are looking for the rare gem that is worthy of one of your 20 slots. This simplifies the entire process, reduces cognitive load, and allows you to focus all your analytical energy on the very few candidates that have a chance of meeting your elevated criteria. It is a psychological masterstroke, using our own inherent biases against us to enforce a state of patient, rational discipline. To operationalize the 20-slot punch card philosophy, an investor needs a practical tool, a blueprint that translates this thought experiment into a concrete, repeatable process. The most effective method is to create and maintain a decision journal. This is not just a record of your trades, it is a formal chronicle of your investment thinking, designed to enforce the discipline the punch card demands. Here is a step-by-step guide to creating and using one. First, get a physical, high-quality notebook, or create a dedicated digital document that is for this purpose alone. This act of creating a formal space for your decisions gives them weight and seriousness. On the first page, write down your investment philosophy and the rules of your 20-slot punch card. For example, I will only make 20 major capital allocation decisions. Each decision will be documented here. An idea must be within my circle of competence, represent a wonderful business, and be available at a significant discount to its intrinsic value to qualify for a punch. Second, before you ever make an investment, you must create a new entry in your journal. This entry must be structured and detailed. It should include the date, the name of the company, the current stock price, and, most importantly, a detailed investment thesis written in your own words. This thesis should answer several key questions. Why is this a great business? What is its durable competitive advantage? Who are the managers and are they able and honest? What is my conservative estimate of its intrinsic value? And how did I arrive at that number? What are the biggest risks to this thesis? This process of writing it all down forces clarity of thought. It moves the idea from a vague notion in your head to a concrete, testable hypothesis. Third, and this is the crucial step, at the bottom of the entry, you must formally write, "This investment qualifies as punch #X of 20. This simple act is the physical manifestation of the mental model. It forces you to confront the gravity of the decision. Is this idea really good enough to be one of only 20? This will cause you to abandon the vast majority of your good ideas, leaving only the truly exceptional. Fourth, after you've made the investment, your work with the journal is not done. You should periodically review your decisions. Once a year, go back and read your original thesis for each of your punched slots. Is the thesis playing out as you expected? Have the company's fundamentals changed? This review process creates a powerful feedback loop for improving your investment mindset. You will learn more from analyzing your past decisions, both the good and the bad, than from any book or news article. You'll see where your analysis was strong and where it was flawed, allowing you to refine your approach for the next punch. This decision journal is the practical application of the 20-slot rule. It transforms you from a market speculator into a disciplined business analyst. It slows down your decision-making, forces deep thinking, and builds a library of your own financial history that becomes your most valuable educational tool. It is the essential blueprint for anyone serious about long-term investing and achieving true financial freedom. To truly grasp the genius of the 20-slot punch card, it is essential to examine its antithesis, the path of the 99%, embodied by the hyperactive trader. This individual operates under a completely different set of assumptions and psychological drivers, leading to a vastly different and almost universally worse outcome. The hyperactive trader believes that wealth is a product of activity. They see the market as a fast-flowing river of money, and their job is to be constantly dipping their bucket in and out to catch some of the flow. Their screen is a dizzying array of charts with moving averages, RSI indicators, and Bollinger Bands. They are not investing in businesses, they are renting stocks. Their holding period is measured in days, hours, or even minutes. Their mornings begin not with reading a business's annual report, but with scanning pre-market news for stocks that are in play. They are looking for volatility, for momentum, for any stock that is moving, regardless of the underlying quality of the business. They might buy a pharmaceutical stock on news of a promising drug trial, only to sell it 2 hours later for a small gain, and move into an oil stock that's spiking because of a geopolitical event. There is no circle of competence here, only a frantic chase after whatever is hot. The psychological state of the hyperactive trader is one of constant stress and anxiety. They are tethered to their screen, experiencing a roller coaster of emotions with every tick of the market. A small profit brings a fleeting rush of euphoria and genius. A small loss brings a wave of panic and self-doubt. This emotional state is poison to rational decision-making. They are perpetually susceptible to the most powerful and destructive biases. They buy into euphoria at the top and sell into panic at the bottom. They are pure herd behavior. The financial consequences of this path are predictably disastrous. First, there are the explicit costs. Commissions from dozens or hundreds of trades a year eat away at their capital. The bid-ask spread, the small difference between the buying and selling price of a stock, acts as a hidden tax on every single transaction. And, most significantly, any gains are taxed at the highest possible short-term capital gains rates, often double the rate for long-term investments. These costs create a massive, permanent headwind. To simply break even, they need to consistently generate returns that are several percentage points higher than a patient investor, a feat that is virtually impossible over time. Second, they mistake luck for skill. In the short run, random chance can lead to a string of winning trades, creating a dangerous illusion of mastery. This reinforces their bad habits and encourages them to take even bigger risks. But over thousands of trades, the relentless mathematics of costs and the lack of any real analytical edge will grind their account down to dust. The hyperactive trader is the polar opposite of the 20-slot investor. One pursues action, the other pursues conviction. One seeks volatility, the other seeks value. One holds for minutes, the other for decades. The path of the 99% is a frantic, expensive, and emotionally draining sprint that almost always ends in failure. The path of the punch card investor is a calm, disciplined, and profitable marathon. The direct financial connection between the 20-slot punch card philosophy and building a fortune is mathematically undeniable. It creates a massive financial advantage through two primary mechanisms: the radical reduction of costs and the maximization of the power of your best ideas. Let's first quantify the impact of cost reduction. Imagine two investors, both starting with $100,000. Investor A is the hyperactive trader, making 50 round-trip trades a year. Let's be conservative and say each trade costs just $10 in commissions, and the bid-ask spread costs another 0.1% of the transaction value. Over a year, their trading costs alone could easily be thousands of dollars. Furthermore, let's say they manage to achieve a gross return of 12% before taxes. Because all their gains are short-term, they might pay a 35% tax rate, reducing their net return to just 7.8%. Investor B is the punch card investor. They make one investment decision a year, or even one every few years. Their transaction costs are negligible. They hold their investments for many years, so when they do eventually sell, their gains are taxed at the favorable long-term capital gains rate of 15% or 20%. If they also achieve a 12% return, their net after-tax return could be 10.2% or higher. Over a 30-year period, this seemingly small difference in annual return is monumental. The hyperactive trader's $100,000 grows to about $980,000. The punch card investor's $100,000 grows to over $1.7 million. The patient investor ends up with nearly double the wealth, simply by minimizing the financial friction of unnecessary activity. But the more powerful mechanism is how this philosophy impacts the core of wealth building, the allocation of capital. Because the punch card investor is forced to be so selective, they don't just put 1% or 2% of their portfolio into their best ideas. An idea worthy of one of only 20 lifetime slots is worthy of a significant capital commitment, perhaps 10%, 15%, or even more of their portfolio. This is the heart of a CEO mindset. When a company's CEO finds a fantastic project with enormous potential returns, they don't allocate a tiny fraction of the company's capital to it. They fund it aggressively. Your portfolio should be run with the same logic. Let's return to our example. Imagine both investors find a truly great company that increases in value tenfold over a decade. The hyperactive trader, being diversified across dozens of hot ideas, had only a 2% position in this winner. Their $100,000 portfolio sees a gain of $18,000 from this fantastic pick. It's nice, but it's not life-changing. The punch card investor, having done the deep work and gained immense conviction, allocated 15% of their portfolio to it. Their $100,000 portfolio sees a gain of $135,000 from that single decision. That is a life-altering return. This is how real wealth is built, not by collecting 100 mediocre ideas, but by identifying a few truly exceptional ones and backing them with conviction. The 20-slot punch card is the mental framework that provides the discipline to wait for those exceptional ideas and the courage to act decisively when they appear. It is the bridge between a sound investment strategy and its tangible, multi-generational financial result. You've defined your circle of competence, your personal battlefield where you have a genuine edge. You've adopted the 20-slot punch card mindset, instilling a profound sense of discipline and patience, forcing you to wait for the truly exceptional. But this raises the next critical question. When one of these rare opportunities appears within your circle, how do you know it's truly great? How do you distinguish a merely good pitch from the fat pitch that can make a career? This leads us to the third pillar of the Buffett philosophy, the art of waiting for the fat pitch. This concept, borrowed from the world of baseball, is the ultimate filter for asymmetric opportunity, a mental model for identifying situations where the potential reward massively outweighs the potential risk. The legendary baseball player Ted Williams was one of the greatest hitters of all time. His secret was not just a quick swing, but incredible discipline. In his book, The Science of Hitting, Williams published a diagram of the strike zone, divided into 77 individual baseballs. He had calculated his batting average for a pitch in each of those 77 locations. He knew that if he swung at a pitch in his happy zone, right down the middle of the plate, he would bat .400. If he swung at a pitch on the low outside corner, his average dropped to .230. His strategy was simple: don't swing at the low outside pitches, wait for the pitch to come into your sweet spot. As Buffett famously said, the trick in investing is to just sit there and watch pitch after pitch go by and wait for the one that's right in your sweet spot. And if people are yelling, "Swing, you bum," ignore them. The key difference is that in investing there are no called strikes. You can wait forever for the perfect pitch to arrive without any penalty. The market will throw thousands of pitches at you every single day. Merger announcements, new product launches, earnings reports. 99.9% of them are low outside corner pitches, mediocre opportunities with mediocre odds. The amateur investor feels compelled to swing at everything. The professional investor waits patiently for the fat pitch, right down the middle. The most powerful anecdote illustrating this principle is Buffett's investment in American Express in the aftermath of the salad oil scandal of 1963. This story is a masterclass in independent thinking and seizing opportunity when fear grips the market. At the time, American Express was primarily known for its traveler's checks and charge cards, but it had a lesser-known division that operated a warehousing business. One of their biggest customers in this division was a company called Allied Crude Vegetable Oil, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had devised a massive scam. He would take out huge loans using his inventory of salad oil as collateral. The problem was, the inventory didn't exist. His giant tanks were mostly filled with seawater, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude Vegetable Oil collapsed, defaulting on over $150 million in loans, $1.5 billion in today's money, that had been guaranteed by American Express warehouse receipts. The market panicked. Wall Street assumed that American Express would be on the hook for all of it, a liability that could potentially bankrupt the company. Fear and uncertainty gripped investors, and the stock price of American Express was cut in half, plummeting from over $60 to $35. This was a crisis. It was a messy, complicated, and terrifying situation. For most investors, it was a pitch in the dirt, something to be avoided at all costs. But for Warren Buffett, it was potentially a fat pitch, drifting right over the heart of the plate. Instead of relying on Wall Street rumors and newspaper headlines, Buffett did his own primary research, his own scuttlebutt. He went out and observed reality. He visited restaurants and hotels, he talked to merchants, he went to banks and travel agencies. He was looking for the answer to one simple question. Was this scandal affecting the core business of American Express? Was the public losing faith in their iconic travelers' checks and charge cards? The answer he found was a resounding no. Customers were still using the cards. Merchants were still accepting them. Travelers still saw the travelers' checks as being as good as gold. The fundamental competitive advantage of the business, its powerful brand, and the trust it commanded was completely intact. He concluded that the market was making a classic mistake. It was taking a single, albeit large, problem in a small, non-core division and extrapolating it to mean the entire franchise was ruined. He calculated that even in a worst-case scenario, American Express's liability would be manageable, and that the underlying earning power of its core business was worth far more than the current, panic-driven stock price. With this deep, proprietary insight, he acted with massive conviction. He invested 40% of his investment partnership's entire capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company sorted out its legal issues and the market realized the core franchise was unharmed, the stock price tripled. That single decision, that one swing at a perfect fear-induced fat pitch, was a home run that helped lay the foundation for the future Berkshire Hathaway. It is the perfect illustration of the principle: do the work, wait for the irrational panic of others to create a massive mispricing in a great business you understand, and then swing with decisive force. The psychological principle at the heart of waiting for the fat pitch is the ability to master the twin demons of the market, fear and greed. More specifically, it's about weaponizing the fear and greed of others for your own gain. Markets are driven by human emotion. Periods of greed lead to bubbles, where valuations become detached from reality. Think of the dot-com bubble or the housing mania of the mid-2000s. In these times, there are no fat pitches to be found. Everything is overpriced and risk is high. The disciplined investor does nothing, letting these pitches go by no matter how tempting they look. The truly fat pitches are created during the opposite emotional extreme, periods of intense fear. This is when a crisis hits, a market crash, a scandal, a recession. The herd mentality takes over. People don't sell because their analysis has changed. They sell because everyone else is selling. Their fear of loss becomes all-consuming. This panic creates incredible opportunities for the rational investor who has done their homework and is emotionally prepared. This is where you can buy a wonderful business for a fraction of its true worth, as Buffett did with American Express. To be the one buying when everyone else is panicking requires immense emotional fortitude. You are acting in direct opposition to the crowd, which feels unnatural and dangerous. Every headline is telling you you're wrong. Your friends and family think you're crazy. This is where the cognitive bias of social proof works against the 99%. Most people look to others for cues on how to behave, especially in times of uncertainty. If everyone is selling, the safe, comfortable thing to do is to sell as well. The fat pitch investor must consciously override this deep-seated instinct. They rely not on social proof, but on their own independent analysis and what Buffett calls an inner scorecard. Their measure of success is not whether others agree with them, but whether their analysis is sound and their facts are correct. They are playing their own game, not the market's emotional game. This mindset also leverages the loss aversion of others. When a stock price falls dramatically, the pain of that loss causes investors to sell indiscriminately, just to make the pain stop. They are not making a rational calculation of the company's long-term value. They are making an emotional decision to staunch the bleeding. The fat pitch investor understands this dynamic. They see the falling stock price not as a danger, but as a signal of potential opportunity, a sign that fear is overwhelming reason. They can step in and absorb those shares at bargain prices precisely because others are too afraid to hold them. Being a fat pitch investor, therefore, is less about financial modeling and more about emotional mastery. It's about cultivating the patience to do nothing during periods of euphoria and the courage to act decisively during periods of terror. It is the applied psychology of being a contrarian, not for the sake of being different, but for the sake of being rational when others cannot. To systematically identify these rare career-making opportunities, you need an applied mental model, a blueprint that acts as a filter. The most effective tool for this is the investment checklist, a concept championed by Charlie Munger. A checklist is a simple but powerful way to ensure discipline and prevent emotion from clouding your judgment, much like a pilot uses a pre-flight checklist to prevent catastrophic errors. Your personal checklist for identifying a fat pitch should be built around 4 critical pillars. Pillar 1, the competence question. The very first item on the checklist must be, is this business squarely within my circle of competence? If the answer is anything other than an immediate and unequivocal yes, the analysis stops. You fold your hand and move on. This single question eliminates 99% of all potential investments, saving you an immense amount of time and protecting you from your own ignorance. You can only identify a fat pitch in a game you deeply understand. Pillar 2. The business quality question. If the company is within your circle, the next question is this a truly wonderful business with a durable competitive advantage, or moat? You must become a moat detective. Does the company have a powerful brand like Coca-Cola? Does it benefit from a network effect like American Express? Is it the low-cost producer in its industry like Geico? Does it have high switching costs that lock in customers? A fat pitch is not just about a low price, it's about a low price on a high-quality asset. Buying a mediocre business at a cheap price is a value trap. You want to buy a superstar company when it's temporarily on the sale rack. Pillar 3, the management question. The third checkpoint is the business run by able and honest managers? You are not just buying a collection of assets, you are partnering with the people who run the company. Read their shareholder letters. Listen to their conference calls. Do they speak in clear, plain language, or do they use obfuscating jargon? Do they admit their mistakes? Most importantly, do they have a track record of intelligent capital allocation? A great business can be ruined by poor management, and a great management team can elevate a good business to greatness. You must have confidence in the jockey as well as the horse. Pillar 4, the price question. Only after the first 3 questions have been answered with a resounding yes do you even consider the price. The final question is the stock available at a significant discount to my conservative estimate of its intrinsic value? This is the concept of the margin of safety. You calculate what you believe the business is truly worth and then demand to buy it for much less, perhaps 60 or 70 cents on the dollar. This discount provides your protection against bad luck, errors in your judgment, or unforeseen problems. The larger the margin of safety, the fatter the pitch. This 4-step checklist is the practical blueprint for waiting for the fat pitch. It forces a systematic, rational process. It ensures you are only swinging at opportunities that are in your sweet spot, that represent high-quality assets with trustworthy management, and that offer a massive margin of safety. It is the ultimate tool for filtering out the noise and identifying the truly asymmetric bets that can transform your financial future. To truly understand the power of waiting for the fat pitch, we must examine the antithesis, the path of the 99%, which is defined by a constant, desperate swinging at every pitch. This investor is driven by the fear of missing out and the belief that they must always be, quote, fully invested. They cannot stand the idea of holding cash, viewing it as a non-productive asset that is losing to inflation. This mindset leads them to constantly lower their standards, accepting mediocre opportunities just to stay in the game. Let's call this investor Fiona. Fiona has a portfolio of 40 different stocks. She doesn't really have a circle of competence. She owns a little bit of everything: a bank stock, a tech stock, a consumer goods company, an oil driller. Her rationale for buying each was not deep conviction, but a vague sense that they were pretty good companies at a fair price. She bought the bank because a TV analyst recommended it. She bought the tech stock because it had good momentum. She bought the consumer goods company because it pays a dividend. Her portfolio is a collection of swing-at-every-pitch decisions. She has no fat pitches, only a series of bunts and base hits. The consequences of this approach are the slow, silent death of diversification and the guarantee of mediocre returns. Because she owns so many companies, the success of any single one has a negligible impact on her overall wealth. If one of her stocks doubles, it might only move her total portfolio value by 2%. Her winners are starved of capital. At the same time, her losers still drag down her performance. This approach leads to a return that will, at best, mirror the market average, but is more likely to underperform it after accounting for taxes and trading costs. Furthermore, Fiona's lack of deep conviction in any of her positions makes her vulnerable during a downturn. When the market falls 20%, she looks at her 40 stocks and feels a general sense of unease. She doesn't have the deep knowledge of any single company to confidently say, "This business is fine. The price drop is a buying opportunity." Instead, the fear is spread across her entire portfolio. She is likely to trim her positions or sell out altogether, locking in losses at the worst possible time. She is swinging at every pitch on the way up and then dropping the bat in fear on the way down. This is the fate of the investor who lacks the discipline to wait. They are constantly in motion, but they are going nowhere. They mistake being in the market with having a sound investment strategy. Their portfolio is a mile wide and an inch deep, ensuring they will never benefit from the explosive power of a single, well-timed, high-conviction swing at a fat pitch. It is a path of guaranteed mediocrity, born from an inability to patiently wait for the exceptional. The direct financial connection between the fat pitch investment strategy and extraordinary wealth building is rooted in the mathematical concept of asymmetric returns. An asymmetric opportunity is one where the potential upside is many multiples of the potential downside. Waiting for a fat pitch is a systematic process for finding and exploiting these rare situations. Let's quantify this. When Buffett invested in American Express at $35 per share, his analysis showed that the company's core business was sound and earning significant, growing profits. He likely calculated a conservative intrinsic value of, say, $70 per share. His downside risk was limited. Even if the salad oil liabilities were worse than expected, the underlying earning power of the business provided a floor on the value. It was highly unlikely to go to zero. Perhaps his downside was to $25. So his risk was about $10 per share. His potential upside, however, was to at least $70, and likely more as the business grew over time. His potential reward was $35 or more per share. He was risking $1 to potentially make $3 or $4 or $5. This is a classic asymmetric bet. This is the financial anatomy of a fat pitch. When you build a portfolio around these types of opportunities, you are tilting the laws of probability dramatically in your favor. A single successful fat pitch investment can have a transformative impact on your net worth, an impact that can cover the cost of several small mistakes or missed opportunities. Imagine a portfolio of 10 positions. If 9 of them are mediocre and return nothing over 5 years, but the 10th is a fat pitch that increases tenfold, the overall portfolio has still doubled. The immense power of the single big winner overwhelms the mediocrity of the rest. This is how fortunes are made in the stock market. Contrast this with the swing-at-every-pitch approach. That investor buys a stock for $50 that they think is worth $60. They are risking, say, $15 of downside to make $10 of upside. This is a symmetric, or even a negatively asymmetric, bet. Their risk is greater than their potential reward. It is mathematically impossible to build significant wealth by repeatedly making these kinds of low-upside, high-risk bets. The fat pitch strategy directly impacts your portfolio's compound annual growth rate, the ultimate measure of investment success. By avoiding the low-probability bets and concentrating your capital into the rare high-probability, high-reward opportunities, you dramatically increase your long-term rate of return. This is the essence of beating the market. You are not trying to be smarter than everyone else on every single stock. You are simply waiting for the rare moments when the market, in its emotional excess, offers you a bet with odds so heavily skewed in your favor that it is, in the words of Charlie Munger, like a license to print money. This is the tangible financial outcome of mastering the art of the wait. It is a strategy for entrepreneurs, for CEOs, for anyone with a long-term mindset who understands that true financial freedom comes not from constant action, but from occasional, decisive, and overwhelmingly intelligent action. We have now established 3 foundational pillars, defining your circle of competence, adopting the 20-slot punch card for discipline, and patiently waiting for the fat pitch. But there is a powerful, defensive counterpart to this offensive strategy. It's a principle that is less about what you do and more about what you actively choose not to do. This is the 4th pillar, the power of no. If the first 3 pillars are about identifying the handful of ideas you should say yes to, this pillar is about the discipline to say no to the thousands of other enticing, alluring, and ultimately distracting opportunities that will come your way. This is perhaps the most difficult discipline to master, but it is the ultimate guardian of your capital and your focus. For every great yes in Warren Buffett's career, there were thousands of no's. He has said no to industries he didn't understand, no to companies with questionable management, no to deals that were priced too high, and no to investment fads that were sweeping the nation. This relentless process of elimination is just as important as the process of selection. To understand the catastrophic cost of a single yes that should have been a no, we must examine what Buffett himself calls his biggest investment mistake. A mistake so profound that he has used it as a cautionary tale for decades. This was the acquisition of Dexter Shoe Company in 1993. At the time, Dexter Shoe was a successful, American-based shoe manufacturer. It had a decent brand, a long history of profitability, and was exactly the kind of simple, understandable business that Buffett liked. He met the management, liked them, and was impressed with the business. He was so confident, in fact, that he decided to buy the entire company, not with cash, but with Berkshire Hathaway stock. He paid $433 million in Berkshire shares for Dexter Shoe. This was a fateful decision. What Buffett failed to appreciate was that the company's competitive moat, which had seemed so durable, was about to be completely erased. Low-cost foreign competitors began to flood the market with shoes that were just as good but far cheaper to produce. Dexter's business model, based on domestic manufacturing, was no longer viable. Its profitability evaporated, and eventually, the entire business became worthless. Buffett had to write off the entire investment. But the true cost was far, far greater than the initial $433 million price tag. Because he had paid with Berkshire stock, the real cost was what those shares would be worth today. As of his recent shareholder letters, Buffett has calculated that the block of shares he traded for Dexter Shoe would now be worth over $12 billion. It was a multi-billion-dollar mistake. A single yes at the wrong time for the wrong business wiped out more potential wealth than 100 small successes could ever have created. In his own words, "I bought a business that was destined to go to zero, and I paid for it, with a business that was destined to be worth a staggering amount." This painful anecdote serves as the ultimate lesson in the power of no. The Dexter Shoe deal had many attractive qualities. It passed many of the initial filters, but it failed on a crucial one: the durability of its competitive advantage. A more rigorous application of no, a deeper skepticism about the long-term future of the American shoe industry, could have prevented this catastrophic error. The experience seared into Buffett the understanding that avoiding a single large mistake is often more important than achieving a dozen small wins. The primary job of an investor is capital preservation, and the most powerful tool for preserving capital is the simple two-letter word, no. The psychological principle behind the power of no is the conscious effort to overcome a slew of cognitive biases that push us towards action and agreement. The first and most powerful of these is the commitment and consistency bias. Once we have invested time and energy in researching an idea, we feel a psychological pull to see it through. We want our effort to have been worthwhile, which makes it very difficult to walk away, even if we uncover information that suggests it's a bad idea. Saying no after hours of work feels like admitting defeat. The disciplined investor must be willing to abandon a flawed idea without a second thought, recognizing that the time spent was a sunk cost, and that the only thing that matters is the quality of the decision going forward. Another major bias is the social proof we discussed earlier, but in this context it relates to the pressure to conform to popular opinion. When a stock is a market darling and every analyst is recommending it, saying no is an act of social defiance. It requires you to stand apart from the crowd and trust your own judgment over the consensus. This is psychologically taxing. Our brains are wired to seek safety in the herd, and betting against it feels risky and isolating. Saying no to the popular idea of the day is a deliberate act of intellectual independence. Furthermore, we are all susceptible to what we can call narrative seduction. A company with a charismatic CEO and a compelling story about changing the world can be incredibly alluring. We get caught up in the narrative and our analytical brain shuts down. The power of no is the ability to separate a good story from a good business. It's the discipline to say, that's a fascinating story, but the financials don't support it. Or, the valuation already reflects a perfect outcome. It's about being a financial analyst, not a member of the audience. The act of saying no is also a powerful defense against complexity bias. Many investors are drawn to complex strategies or businesses because they seem more sophisticated and intelligent. They believe that a complicated investment must be a better one. Buffett's approach is the opposite. He believes in simplicity. If he cannot understand an investment easily, he says no. He's not trying to prove he's the smartest person in the room by solving the most difficult puzzles. He's trying to get rich by only playing the easy games. Saying no to complexity is a powerful filter that eliminates a vast universe of potential mistakes. Mastering the psychology of no is about cultivating a default state of skepticism. Your starting position for any new idea should not be, why is this a good investment, but rather what could go wrong with this investment. By actively looking for the flaws and the reasons to say no, you force yourself to build a much more robust and well-founded case before you ever commit capital. To turn this psychological principle into a practical, applied mental model, you need to create a system for efficiently rejecting ideas. The most effective system for this is what Charlie Munger calls the too hard pile. This is not just a mental concept. It should be a real, physical, or digital part of your investment process. Here is the blueprint for creating and using your own too hard pile. First, you must define the criteria for what immediately goes into this pile. This is your pre-filter, the set of rules that allows you to say no in seconds, not hours. Your criteria should include 1. Anything outside your circle of competence. If it's a biotech company and you're not a doctor or scientist, it goes directly into the pile. No further analysis needed. 2. Businesses with extreme complexity. If you can't understand how the company makes money and what its key drivers are after reading the first few pages of its annual report, it goes into the pile. This would include complex financial derivatives, companies with opaque accounting, or businesses dependent on technologies you don't grasp. 3. Businesses with high levels of uncertainty and unpredictability. This includes companies whose success depends on a single government contract, the outcome of a major lawsuit, or a binary scientific breakthrough. If the range of possible outcomes is too wide to reasonably handicap, it goes into the pile. 4. Companies run by management with a questionable track record. If the CEO has a history of destroying shareholder value or engaging in shady practices, the company goes straight into the pile, no matter how cheap the stock looks. A bad jockey can ruin even the best horse. The second step is to be ruthless in its application. The too hard pile is your friend. It is the tool that saves you your most valuable asset, your time and attention. Your goal is not to have the smallest too hard pile possible. It is to have the largest one. You should be actively looking for reasons to discard ideas quickly, so you can focus all your energy on the small number of potential gems that remain. There is no shame in putting something in this pile. It is not an admission of intellectual failure, it is a declaration of intellectual honesty. The third step is to never look back. Once an idea is in the too hard pile, it's dead to you. Don't waste mental energy second-guessing your decision or worrying that you might be missing out on a winner. The opportunity cost of constantly revisiting difficult, low-probability ideas is that you will miss the obvious, high-probability fat pitch that is staring you in the face. This system fundamentally changes your investment workflow. Instead of a universe of thousands of stocks to choose from, you have a process that quickly narrows that universe down to a tiny, manageable number of high-quality candidates that fit your specific criteria and fall within your circle of competence. It is the ultimate tool for simplifying investing and operationalizing the power of no. It allows you to protect your capital and your focus, which are the essential ingredients for long-term success. The antithesis of the power of no is the yes-man investor, a common archetype among the 99%. This individual is pathologically unable to reject an idea, especially one that comes with a compelling story. They are susceptible to every sales pitch, every market fad, and every can't-miss opportunity. Their portfolio is not a curated collection of high-conviction bets, but a messy, overstuffed museum of bad ideas they couldn't bring themselves to reject. Let's imagine this investor, we'll call him Sam. Sam's inbox is full of newsletters promising to identify the, quote, next Amazon. His browser history is a long list of articles about speculative mining stocks, cannabis companies, and disruptive tech startups. He is a collector of story stocks, companies that have a great narrative but little to no earnings or revenue. He said yes to a 3D printing company in 2014 because it was the future. He said yes to a blockchain company that didn't actually use blockchain in 2017. He said yes to a meme stock in 2021 because a community of online posters was convinced it would go to the moon. Each time, he was seduced by the story and the fear of being left behind. His process lacks any sort of critical filter. He does not ask, what could go wrong? He only asks, how high could this go? He doesn't have a too hard pile, he has a this sounds exciting pile, which includes almost everything. The financial consequences for the yes-man investor are a slow and painful erosion of capital. His portfolio is filled with companies that burn through cash and have a high probability of failure. For every one that might experience a short-term pop, he has 5 that slowly drift down to 0. He is constantly catching falling knives, buying more of a losing stock because he is emotionally committed and cannot admit he made a mistake. His balance sheet is a graveyard of yeses that should have been nos. He is violating the first rule of successful portfolio management, capital preservation. By saying yes to everything, he ensures that his capital is constantly exposed to high-risk, low-probability bets. He will never achieve the compounding effect that builds real wealth, because his gains are constantly being offset by the catastrophic losses from his many ill-conceived ventures. The yes-man investor is a product of an investment mindset that lacks skepticism and intellectual honesty. He is playing a game of addition, constantly seeking the next thing to add to his collection. The successful investor, in contrast, plays a game of subtraction, constantly looking for reasons to eliminate ideas and keep their portfolio clean, focused, and filled only with the highest quality opportunities. The power of no is the dividing line between these two fundamentally different and financially divergent paths. The direct financial connection between mastering the power of no and your financial statements is profound and operates on two levels: defense and offense. On a defensive level, the connection is clear. It is the primary driver of capital preservation. Every no to a bad idea is a direct prevention of a future loss. Consider the impact of a single catastrophic loss on a portfolio. If you have a $100,000 portfolio and one of your $10,000 investments goes to zero, like Dexter's shoe, you have lost 10% of your capital. To get back to even, your remaining $90,000 portfolio now needs to generate a return of 11.1%. If you suffer a 50% loss, your portfolio drops to $50,000. You now need a 100% return just to break even. The mathematics of loss are brutal and unforgiving. By saying no to speculative, poorly understood, or overpriced ventures, you are systematically eliminating the potential for these large, portfolio-crippling losses. This makes the job of compounding your wealth infinitely easier. It keeps your capital base intact, allowing your good decisions to generate returns on a larger and larger sum of money over time. This is the financial embodiment of the rule: never lose money. But the power of no also has a powerful offensive benefit. By clearing your mind and your portfolio of dozens of mediocre maybes, you create the financial and psychological space to act with massive conviction when a true yes comes along. This is the essence of building a focused, high-performance portfolio. If you have your capital spread thinly across 50 different pretty good ideas, you lack the firepower to make a meaningful bet when a truly great opportunity, a genuine fat pitch, appears. Your ability to say no to the 49 mediocre ideas is what allows you to say yes, with a significant allocation of capital, to the one great idea. This is how the power of no directly enables the strategy of concentration, which is the ultimate engine of wealth creation. On a balance sheet, a portfolio built on the power of no looks different. It has fewer positions. It has a higher cash balance at times, reflecting the discipline to wait when no great opportunities are present. The quality of the assets it does hold is significantly higher, with better returns on equity and stronger balance sheets. This approach, which might look undiversified to the 99%, is in fact a deeply de-risked strategy. The risk has been managed upfront through a ruthless filtering process, not downstream through owning a little bit of everything. The financial result is a portfolio with lower volatility, fewer catastrophic losses, and a higher long-term compound annual growth rate. It is the tangible financial reward for embracing the most powerful word in an investor's vocabulary. We have now assembled the complete strategic framework. You've defined your circle of competence. You've embraced the 20-slot punch card to enforce discipline. You've learned to wait for the fat pitch, the asymmetric opportunity. And you've mastered the power of no to protect your capital and focus. The final pillar is the grand synthesis, the culmination of all these principles into a single, powerful portfolio strategy, the concentrated portfolio. This is where the theoretical becomes the actual, where the blueprint is used to construct a fortress of conviction. This is the ultimate expression of the CEO mindset, moving beyond being a mere stock picker to becoming a true business owner. The idea of a concentrated portfolio runs counter to one of the most widely accepted dogmas of modern finance: diversification. We are taught from day one that we should spread our investments across many different stocks, bonds, and asset classes to reduce risk. For the average person who has no interest in studying businesses, this is sound advice. But for the serious investor, the one who has done the hard work of the preceding 4 pillars, diversification, as Peter Lynch called it, is a path to mediocrity. Warren Buffett has been one of the most vocal critics of over-diversification, famously stating, "Diversification is a protection against ignorance." It makes very little sense if you know what you're doing. A concentrated portfolio is the logical outcome of a process based on competence, patience, and extreme selectivity. If you are only going to make 20 decisions in your lifetime, and you are waiting for perfect pitches, it makes no sense to put only a tiny fraction of your capital into these rare, high-conviction ideas. A concentrated portfolio is the act of backing your best ideas with meaningful capital. To understand this in practice, one only needs to look at the portfolio of Berkshire Hathaway itself. For decades, the vast majority of its publicly traded stock portfolio has been concentrated in just a handful of names. At various times, companies like the Washington Post, Coca-Cola, American Express, or Wells Fargo have constituted enormous positions, sometimes representing 25% or more of the entire stock portfolio. The most stunning modern example of this is Buffett's investment in Apple. For years, Buffett famously avoided technology stocks, adhering to his circle of competence. But starting around 2016, he began to study Apple. He realized that he had been thinking about it as a technology company, when he should have been thinking about it as a consumer products company, with an incredibly powerful, global brand and an ecosystem that created immense customer loyalty and switching costs. The iPhone, he concluded, was an indispensable part of modern life, and the Apple brand commanded a level of devotion and pricing power that was on par with the greatest brands he had ever studied. It had a deep, durable moat. It was squarely within his now expanded circle of competence. He saw it as a fat pitch. The market was worried about slowing iPhone growth. But Buffett saw a company with staggering profitability, a massive share buyback program, and a valuation that was incredibly reasonable for a business of its quality. And so, he acted with conviction. Between 2016 and 2018, Berkshire Hathaway bought over $36 billion worth of Apple stock. It was a massive bet. By the time he was done, Apple represented over 25% of Berkshire's entire stock portfolio, and today it accounts for nearly half. This single concentrated bet has been an astronomical success, generating over $100 billion in unrealized gains for Berkshire shareholders. This was not a lucky gamble. It was the final, decisive action at the end of a long, disciplined process. It was the logical result of competence, patience, and selectivity, all culminating in the construction of a concentrated position in a wonderful business. This is the fifth pillar in action. The psychology behind building a concentrated portfolio is a direct confrontation with the conventional wisdom around risk and diversification. The core psychological shift is in how you define risk. The academic world defines risk as volatility, the degree to which a stock's price fluctuates. According to this definition, a concentrated portfolio is very risky because the price swings of a few large positions will cause the total portfolio value to be more volatile. Buffett and Munger have a completely different definition of risk. They define risk as the probability of a permanent loss of capital. From this perspective, a concentrated portfolio of 10 businesses that you have deeply researched and understand inside and out is far less risky than a diversified portfolio of 100 businesses you know nothing about. Your deep knowledge of your chosen companies is your primary risk management tool. It allows you to hold firm, or even buy more, during a market panic when the price of your stock is falling, because you have confidence in the long-term value of the underlying business. The owner of the 100 stock portfolio, lacking this conviction, is the one who is truly at risk of panicking and selling at the bottom. Building a concentrated portfolio also requires a high degree of emotional conviction and the ability to withstand psychological discomfort. Your performance will, by definition, deviate significantly from the market averages. There will be periods, sometimes lasting for years, when your concentrated bets underperform and you will look foolish. This is the price of admission for superior long-term returns. You must be willing to look wrong in the short term to be right in the long term. This requires a strong inner scorecard and the ability to tune out the noise of the market and the opinions of others. Furthermore, this approach leverages the familiarity principle, our natural tendency to feel more comfortable with things we know well. By concentrating on a few companies, you can achieve a level of familiarity that is impossible with a diversified portfolio. You will know their history, their products, their managers, and their financials like the back of your hand. This deep familiarity breeds a rational, justifiable confidence that is the antidote to the fear and greed that drive the decisions of most market participants. It is a psychological state of calm, focused ownership, which is the ideal mindset for long-term wealth building. So how does one build this fortress of conviction? What is the practical blueprint for constructing a concentrated portfolio? It is a multi-step process that builds upon all the previous pillars. Step 1 is the rigorous application of your filters. From the universe of potential investments, you use your circle of competence, your fat pitch checklist, and the power of no to identify the absolute best 5 to 15 ideas available to you right now. This is your short list of championship caliber businesses. You are not looking for pretty good ideas. You are looking for the elite. Step 2 involves a mental reframing of ownership. You must stop thinking of yourself as a stock picker and start thinking of yourself as a part owner of a business. Before you invest, ask yourself, if I had enough money to buy this entire company, would I do it? Am I comfortable with this being one of my 20 lifetime decisions? This shifts your perspective from short-term price fluctuations to the long-term economic engine of the business. You are not renting a piece of paper. You are acquiring a stake in a productive enterprise. This is the core of the CEO mindset. Step 3 is the process of intelligent capital allocation. Once you have your shortlist, you don't just divide your money equally among them. You allocate the most capital to your absolute best idea, the one with the widest moat, the best management, and the largest margin of safety. Your second best idea gets a smaller allocation, and so on. Your portfolio should be a reflection of your conviction. Your best ideas deserve the most capital. A common framework might be to allocate 15 to 25% to your top idea, 10 to 15% to your next 2 or 3 ideas, and smaller positions for the rest. The exact percentages will depend on your personal risk tolerance, but the principle remains: bet big on your best ideas. Step 4 is the commitment to long-term ownership. A concentrated portfolio is not a trading strategy. You are buying these businesses with the intention of holding them for many years, if not forever. You should only consider selling if one of 3 things happens. 1. The business fundamentals have seriously and permanently deteriorated. 2. The stock has become so wildly overvalued that its future returns are likely to be poor. 3. You have found a new, even better investment opportunity that is significantly more attractive than one of your current holdings. You do not sell because of a market downturn or because you've made a quick profit. You hold on and let the power of compounding work its magic. This blueprint transforms portfolio management from a scattered, reactive activity into a focused, proactive, and business-like endeavor. It is the final practical step in implementing a complete, coherent, and powerfully effective investment strategy for long-term wealth building. To fully cement the wisdom of concentration, we must analyze its antithesis, the path of the 99%, which is diversification. This is the investor who has been told that owning hundreds of stocks or a dozen different mutual funds is the safe and smart way to invest. Let's call this investor Diana. Diana has a brokerage account with positions in 150 different companies. She also owns 8 different mutual funds: a large-cap growth fund, a small-cap value fund, an international fund, a real estate fund, and so on. She believes she is well diversified and therefore safe. The reality is that Diana has created a portfolio that is a closet index fund, but one that is far more expensive and less effective. By owning so many stocks, she is guaranteed that her performance will almost perfectly mirror the market average before fees. Her best ideas, if she even knows which ones they are so diluted that their success has no meaningful impact. A stock that triples in value is just a blip in a 150 stock portfolio. At the same time, she is likely paying high management fees for her mutual funds, which are themselves highly diversified and hold many of the same stocks she already owns. She is paying for active management but is receiving a passive index-like return. This is the worst of all worlds. The most damaging consequence of diversification is the illusion of knowledge. Diana feels sophisticated because she owns a complex-looking portfolio, but in reality, she has no idea what she truly owns. She cannot tell you the business model or competitive advantages of the 57th largest holding in her small-cap value fund. She lacks any real conviction. As a result, when a market crisis hits, she is completely adrift. She has no analytical anchor, no deep understanding of any of her assets to give her the confidence to hold on. Her diversification, which was supposed to be a source of safety, becomes a source of confusion and fear. She is far more likely to panic and sell everything at the bottom than the concentrated investor who knows their 5 companies inside and out. Diversification is not a strategy for risk reduction. It is a strategy for ignorance management. It is a tacit admission that the investor does not know how to identify great businesses, so they choose to own a little bit of everything in the hope that it all works out. It is a guarantee of mediocrity and a renunciation of the possibility of extraordinary returns. It is the final, predictable outcome for the investor who has failed to embrace the principles of competence, discipline, selectivity, and conviction. The direct financial connection between a concentrated portfolio and the creation of massive wealth is the most powerful in this entire framework. It is the final link in the chain, translating all the intellectual and psychological work into tangible, life-changing financial results. The mathematics are simple but profound. True wealth is not built by earning 8% a year. It is built by finding a few investments that can return 5, 10, or 20 times your initial capital over a long period. A concentrated portfolio is the only structure that allows these multi-baggers to have a meaningful impact on your net worth. Let's run the numbers. Imagine you have a $100,000 portfolio. Investor Diana, the diversifier, finds a great company that goes up tenfold over a decade. But it was only a 1% position in her 100-stock portfolio. Her $1,000 investment becomes $10,000. She made a $9,000 profit. A nice result, but it only increased her total portfolio value by 9%. Now consider investor Charles, the concentrator. He finds the same great company. Because it was the result of a rigorous filtering process and was one of his highest conviction ideas, he made it a 20% position. His $20,000 investment becomes $200,000. He made a $180,000 profit. This single decision more than doubled his entire net worth. This is the explosive arithmetic of concentration. This is how you achieve financial freedom. Furthermore, this strategy dramatically simplifies the long-term management of your wealth. Instead of trying to keep track of dozens of companies and mutual funds, you only need to deeply follow a handful of businesses. This is a manageable task. You can read their quarterly and annual reports, listen to their conference calls, and stay abreast of the competitive landscape. This deep, ongoing knowledge is what gives you the conviction to hold through the inevitable market downturns, turning what others see as a crisis into a potential buying opportunity. On your personal balance sheet, the effect is transformative. Your asset column begins to be dominated by significant ownership stakes in a few world-class enterprises. You are no longer just a holder of stocks. You are a capital allocator, a business owner. Your wealth grows not from market timing or clever trading, but from participating in the long-term success of the great companies you've chosen to partner with. This is the culmination of the entire investment strategy, a simple, focused, and profoundly powerful approach to translating deep knowledge into a financial fortress. It is the final promise that by simplifying your approach and focusing your energy, you can achieve a level of financial success that the frantic, overwhelmed, and over-diversified investor can only dream of. You have made it through the entire framework. You have absorbed a complete system of thought that is responsible for creating one of the greatest fortunes in history. You now possess the blueprint for focused competence, a mental model that transforms investing from a game of overwhelming complexity into a manageable, winnable exercise in specialization. You have internalized the 20-slot punch card, a powerful psychological tool to enforce the patience required to bypass mediocre ideas. You understand the art of waiting for the fat pitch, the discipline of swinging only at the rare asymmetric opportunities where the odds are overwhelmingly in your favor. You have learned the defensive power of no and the importance of the too-hard pile in preserving your capital and your focus. And finally, you have seen how these principles culminate in the construction of a concentrated portfolio, a fortress of conviction that is the true engine of massive wealth creation. You now have a mental arsenal that separates you from the 99% of market participants who are driven by emotion, hype, and a fear of missing out. You have the tools to build real, lasting generational wealth. But understanding this system, this powerful engine for decision-making, is only the first part of the equation. The framework you've just learned is the what and the how, what to look for, and how to structure your thinking. But there is another, equally critical dimension that the greatest capital allocators master, the when and the where. It's the understanding of the market landscape itself. This system of thought is an engine, but every engine needs fuel and a map of the terrain it must cross. The fuel is opportunity, and the map is an understanding of market psychology and economic cycles. You have mastered a crucial piece of the puzzle, the personal discipline required for success. But Buffett's complete system is a network of interconnected mental models. Knowing how to identify a great business is one thing. Understanding the market dynamics and psychological tides that cause that great business to become massively mispriced is another. That is the missing link. It is the knowledge that connects your personal competence to the external world of market behavior. The video that is now appearing on your screen is the next piece of that map. It is the bridge from internal discipline to external opportunity. It explains the larger forces at play, the cycles of fear and greed that create the very fat pitches you have been taught to wait for. It is the link that connects the theory of your competence to the practical reality of market psychology. What you have just learned is your sword and your shield. The information in that next video is the art of knowing which battles to fight and when the terrain is most favorable. You have made a significant investment of your time and attention to get to this point. Most people have already clicked away, satisfied with surface-level knowledge. The very fact that you are still here means you are part of a different class of thinker. The question you must now ask yourself is this: are you merely collecting interesting ideas, or are you committed to assembling the complete intellectual arsenal required for true financial sovereignty? The journey to mastery does not end here. This was a critical foundational step. The next piece of the model is waiting for you. Complete the framework. Continue your ascent. Click and discover the missing link.